Namaskar Mitro. Welcome to the channel JIV and CIV Made Simple. This is our BFM Unit number 19. Topic name is Introduction to Treasury Management. We are going to provide you all the contents, all the important contents related to this topic in flowchart and diagram manner as we have been doing in our entire crash course. So let's get started. So this is a visual overview of the integrated treasury operation as you can see. So let's explore the powerhouse behind a bank finance engine that is called integrated treasury. As you can see here, integrated treasury, right? Imagine it has the central nervous system that connect every financial artery from global market to your local branch. But how exactly do it operate? Let's break it down. First thing first is the risk management. We will talk about every aspect of it, and after going through this video, I request you to please solve quizzes which I have added in the today's course. Now first let's talk about the risk management. See, the treasury actively manages the market risk. So it actively manages the market risk management. How? Using some sophisticated tools like derivatives. Yes, it uses some tools like derivative to hedge the market risk, to manage the market risk management, right? And so also it provide hedging against forex risks, forex rate and interest rate fluctuation. This derivative which acts like a tool. Now the question is, why does it matter? What is the significance? Because it not only protect the bank but also strengthen the domestic and the global linkage, right? So that is why this is very much significant. This derivative plays a super important role in hedging foreign risk as well as interest rate exposure, right? Now friends, let's look at the direct customer interface. On the right side you can see integrated treasury is not just about number. It speaks directly with the corporate client. This is called one-to-one interaction. It helps tailor solution, build trust, and bring financial strategies closer to the real business need. If you look at the RBI relaxation here, as you can see, the RBI plays a vital enabling role. It permits mechanism like FDI, foreign direct investment, ECB, external commercial borrowing, ODI, overseas direct investment. So these are some mechanism which are permitted by the RBI. And also we have resident forex operation, right? Plus it allow overseas exposure. RBI allow overseas exposure, but with a smart limit tied to a bank net worth. Yes, so obviously overseas exposure is allowed by it, but there is a limit which is tied to the bank net worth. If you look at the market arbitrage on the right side, as you can see, what about the market arbitrage? Let's discuss it. See, that this is where a strategy meet opportunity. Yes, in market arbitrage what happen? Your strategy it meets your opportunity. Right. So by analyzing market trend, right, bank can switch between rupee and forex. By analyzing the market trend, bank can switch between rupee and forex, right, or tap into global shift like rupee credit to US lending. It's a smart financial maneuvering at its best. That is called market arbitrage. What about the market integration? What about the market integration? As you can see on the right side, see, if we talk about the market integration, so with globalization and fast-paced technology, market are now more connected than ever. Treasury integrate money market, currency market, as well as long to short-term funding and even security trading. This is the very important thing. It integrate everything, global liquidity market, debt market, right? Also money market, currency exchange, long to short term funding, and even security trading is integrated by the treasury. That is the point. Now friends, if you look at the integrated cash flow management, as you can see here, no more silos, no more isolation, right? Treasury ensure a unified approach to managing the cash flow. There is a unified approach which is maintained by treasury. So fund move smoothly across function. It's all about optimization and efficiency. If we talk about the access to the foreign currency, in the left side you can see access to the foreign currency through offshore operation, NRI deposit, EEFC and RFC account, ECB float fund treasury. What ECB do? ECB float fund treasury ensure a steady inflow of foreign currency, making global trade seamless. If you look at the financial reform, so friends, what is the financial reform all about? As you can see here, and there is something called rupee partial convertibility. Financial reform plays a supporting role here. With partial convertibility of the rupee and liberalized capital current account regulation, RBI has opened up treasury for a broader global playground. So remember, rupee is always partially convertible, and current account and capital account, right? Current account is freely convertible, capital account is relaxed, right? Largely RBI relax. So RBI is open up the treasury for a broader global playground. And if you look at the difference between the merchant and trading business, so here you can see the difference between the merchant and the trading business. So the treasury strike a balance between handling customer transaction and managing the bank's own trading strategy. It serves as both service provider and the strategist, right? So customer transaction bank also have to handle, and bank on business they have to handle. So there should be a proper balance between these two, and this is what is ensured by the treasury. So in nutshell, the integrated treasury is not just a department, it is dynamic, multi-dimensional engine driving modern banking. From managing risk to leveraging global market, it ensures that bank is not just surviving but thriving. You can see now different types of functions are it is performing. And then on the top left side we have seen the risk management. We have seen the arbitrage opportunity also someone can take help of, right? We have seen access to foreign currency, some sources I have told you how, and also financial reform also, it is also playing a very important role. So that is all about the roles played by the treasury. Now friends, let's move to the next slide. When we think of a bank treasury, we often imagine a room full of complex financial instruments and high stake decisions. But at its core, the treasury is built around three powerful pillars. What are the three powerful pillars of treasury? Let me show you. The first is called liquidity management, as you can see it here. The second is called proprietary trading, and third is called risk management. Let's decode these one by one. First of all, let's come to the liquidity management. See, the treasury ensure that bank always had the right amount of fund, that is called fund management, whether for short-term needs or long-term plan, right? So proper funds should be always be there. Short-term need, medium-term need or long-term plan in single or multiple currency, right? That is called liquidity management. From managing cash flow to complying with the CRR SLR requirement. So cash flow management is also there, and complying with CRR SLR requirement is also there, right? From managing cash flow to complying with the CRR SLR requirement, it keeps the financial engine running smoothly. It does this through what we call ALM book. Yes, remember there is a book that we call ALM book, right? It is done through the ALM book where internal risk and liquidity needs are monitored and balanced with precision, right? So as you can see, multi-currency compliance, then it maintains reserves. So I told you now that two things, managing cash flow to complying with CRR SLR, that is a part of the liquidity management. Then we have second part that is called the risk management. So after liquidity management then comes risk management. You know what it means? See, risk never sleep, but the treasury is always a step ahead. By using tools like ALM support, there is a tool that is used. ALM support is a tool. By using tools like ALM support, derivative is another tool. Right? And then we have client risk hedging tool. So by using this tool, it safeguard, that means the treasury safeguard the bank finance. Yes, it safeguard the bank finance, right? This role also extend to the proprietary risk management. This particular role of risk management also extend to the proprietary risk management, where the bank protect its own position. And about merchant book, so basically this is part I told you now, the liquidity management is a part of ALM book. Remember, this is very, very important. ALM book, liquidity management, right? And about this risk management, so here you can see this risk management is part of the merchant book. Merchant book plays its part. As you can see, merchant book, client forex, means foreign exchange client plus derivative, right? And it cover foreign exchange transaction and derivative exposure. And if you look at the proprietary trading, what is the meaning of proprietary trading? So beyond customer transaction, bank can trade for its own gain, right? Bank can trade for its own gain, that beyond the customer transaction, right? So treasury actively engage in trading currencies, trading securities and derivative. Currency, security, derivative, all these are actively traded by the treasury. The key objective of boosting profitability. This activity is tracked through the trading book. Remember, this activity, proprietary trading, is tracked through the trading book. So here you can see the ALM book is there for liquidity management. For risk management, you have the merchant book. For proprietary trading, you have the trading book, right? So trading book, what happens in the trading book? Where the bank take calculated position in the market, not for a client but for itself. So here you can see at the bottom, I have just summarized the fact that ALM book, it includes what? Internal risk plus liquidity management. It includes traditional liquidity function, ALM book, remember it. Then merchant book includes derivative and client foreign exchange risk. And if you talk about the trading book, it includes proprietary position. So remember, question is asked that liquidity management is taken care of in which kind of book. So you must remember ALM book. Proprietary trading is taken care of which kind of book. So you must know this is trading book. And what about risk management? This is the part of merchant book. So these things must be clear to you. Now friends, let's switch our focus to the next topic. That, as you can see, just wait a minute, let me show you. So friends, now let's talk about the introduction and impact of the financial derivative in India. Every aspect have been declared, will be clear. Just go through this particular slide, right? That is our main motive, that we try to provide you every aspect in an easy to understand manner. Let's go through. So friends, financial derivative have transformed the Indian financial landscape. Once considered complex, today they are crucial tool for managing risk, enhancing liquidity, and boosting the global connectivity. Let's break them down in their introduction and impact under the regulatory vision of RBI and SEBI. First of all, let's talk about the globalization impact. On the right top side, you can see the globalization impact. As Indian bank and financial institution engage in more forex transaction, derivative help manage cross-border investment. Right, as bank and financial institution engage in forex transaction, derivative help them manage the cross-border investment. Right, both for the client as well as the on investment. In short, globalization is not just a trend; it's an operational shift, and derivative are the bridge. Right, so again I am repeating that as Indian bank and financial institution engage in more forex transaction, derivative help manage cross-border investment. This is a very important thing. It helps them to manage the cross-border investment. Right, then let's say the impact on bank treasury. What is the impact on bank treasury or derivative? See, bank treasury now have access to convertible fund. You know about this convertible fund? So bank treasury now have access to the convertible fund, which can be deployed across domestic or international market, as you can see. So this convertible fund can be deployed across domestic market also and international market also, though of course within the regulatory boundary. It's about smarter fund use driven by strategic derivative tool. This is the impact on the bank treasury. Third thing we have is currency future market. Currency future are traded into two major Indian exchange. What are they? So first of all, what are they? So remember, currency future are traded on two major exchanges, and what are their future? They offer high liquidity, right, and short-term flexibility, typically in 1 to 3 month contract, which is a go-to choice for corporate and investor managing the currency risk. Right. So those who are managing the currency risk, they can go to this currency future market. This is a very good choice for them. Then we have something called CDS. What is CDS? Credit default swap. Basically, it was introduced to manage the credit risk in corporate bond. Remember why it was introduced? To manage the credit risk in the corporate bond, right? And CDS is a very powerful instrument. It acts both like a market maker as well as users. Bank act both like using CDS. Bank act both like market maker and users, right? So hedging through their banking or trading book. It's like insurance for your bond portfolio. So you can call this CDS as insurance. It's like insurance for your bond portfolio. Then we have cross currency future and option. So here you can see at the bottom we have something called cross currency future and on the option. So if you want to hedge a foreign forex exposure in yen while you deal in euro, suppose you want to hedge your forex exposure in yen and you deal in euro, right? So how can you do that? So cross currency future and option help with direct hedging and strategy execution. So here you can see direct hedging and strategic execution, right? No matter the currency pair, whatever the currency pair is, no matter, right? Here you can go about, if you want to hedge a forex exposure in yen while you deal in euro, so cross currency future and option help with the direct hedging and strategy execution. Then we have something called interest rate future, IRF. What is IRF? Do you know what is IRF? Let me show you. On the right hand side you can see interest rate future. See, since 2013, right, IRF are available on the stock exchange in India, right? RBI allotted. And what are their assets? So underlying asset include 91-day treasury bill, 2-year, 5-year, 10-year notional Government of India bond, or coupon bearing Government of India security, which is ideal for those looking to lock in or hedge interest rate movement. Right. What about the RBI guideline? On 26 June 2019, RBI issued a comprehensive guideline covering both exchange traded fund and OTC, that is OTC derivative. You know about the difference? You should know the difference between exchange traded fund and OTC derivative. So these guidelines even cover ETP also, right, and replace earlier outdated direction, which was a much needed regulatory refresh. Now if you look at the overseas borrowing by the bank at the bottom, you can see, remember this is very important thing. Under this framework, what happened, that a bank can borrow overseas via correspondent. Yes, bank can borrow overseas via correspondent, and there is a limit, there is a cap. Either the higher of the 100% of the tier 1 or USD 10 million, whichever is higher, right, ensuring stability even when enabling global expansion. So this limit you must keep in your mind, that for overseas borrowing there is a limit. Either suppose tier 1 is suppose 100 crore. What is 100% of tier 1? That is 100 crore. So either 100 crore or USD 10 million, whichever is higher, right? That is the limit that have been capped on the overseas borrowing by the bank, right? Remember this limit, super important from examination point of view. So everything we are discussing in this particular slide now, they have been appeared in the previous year examination. That is why it is here, right? And in the entire crash course, we ensure that I will provide you only those content which matter from examination point of view, nothing extra. So that your 80% time should be devoted to solving MCQs and case studies as well as quizzes. And if you want everything at one place, our crash course is a perfect solution for you, because in crash course we offer you on daily basis, we provide you such kind of videos, we provide you quizzes based on them, we provide you MCQs based on them, so that you have fully fledged preparation. Now friends, let's shift our focus to the overview of the bank treasury activity. So welcome to the heart of the bank financial engine, the treasury. This is where the precision meets the opportunity. Let's decode the core activity that keep the treasury ticking. So let me zoom a little bit. First, let's talk about the definition of the treasury. I hope it is now visible to you, right? So first of all, let's talk about the definition of treasury. Treasury is not gambling. It is a calculated speculation, right? It is a kind of a calculated speculation, right? Bank profit from price movement, whether it is buying low and selling high or taking a short position. But take a note, short selling in equity is not allowed by RBI. Remember, short selling in equity, this RBI does not allow, right? Then we have currency trading. See, at the center of the bank treasury, like currency trading, at the center of the bank treasury, it's all about currency trading. Here, bank take position in the global currency based on authorized limit, right, from the RBI. Yes, RBI set an authorized limit. Based on that authorized limit, bank take position in the global currency, whether it is long position or short position. It's all about smartly managing the foreign exchange gains, right? That is the currency trading. So it is kind of a speculation activity, just now I told you, right? Now friends, currency swap. So when timing is everything, in currency swap, bank buy and sell the same currency at different time, profiting from interest rate difference. That is called currency swap. So what the bank is doing, he is buying currency at one time and he is selling currency, bank is selling currency at a different time, right? And timing, since timing matter, so it is a powerful tool to manage the forward rate risk and balance exposure. Then we have open position concept. What is the meaning of open position? So open position means the unfinished trade, right? Open, why it is called open? Because it means the unfinished trade, right? So an open position means a trade that is not fully squared off. The value fluctuate with exchange rate movement. Remember, the value fluctuate with the exchange rate movement, and it is tracked carefully to manage exposure and to avoid the risk. That is the concept of an open position. Means trade has not been fully squared off. Then if we talk about the trading in securities, here you can see trading in securities. What does it mean? When treasury trades security, it is often to profit from the yield chain, right? When treasury trade in security, it is often to profit from the yield chain. If yield fall, tell me what will happen. Suppose yield decrease, what will happen? Then government security rise in the value. Obviously price is inversely proportional to the yield. If the yield will decrease, government security value will increase, and that is how bank make gain. This is how bank make gain, especially in the NSE wholesale debt market. That is called trading in security, right? So whenever treasury trades security, it is often to profit from the yield chain. When yield decreases, government security price increases, and this is how the bank gains, right? Now we have SLR and excess holding. Bank maintain SLR, that is called a statutory liquidity ratio, right? And hold excess government security. Both has regulatory requirement as well as liquidity management tools. If we talk about the corporate bond and equity, treasury also invest in corporate bond and non-SLR equity, as you can see it here. Corporate bond plus non-SLR equity, right? So these are just diversification. They are often significant profit contributor. Then equity market activity. So basically a strategic yet restrained. Though treasury do participate in equity market, it is done cautiously. There is a focus on profitability, but exposure is limited due to the market cap, which is set by the RBI. RBI regulation put a market cap on the equity market activity. Then we have something called trading in credit instrument. What is the meaning of trading in credit instrument? See, basically it means spreading the net wider. This includes trading in CDs, right? CD, certificate of deposit, commercial paper, NCDs, non-convertible debenture, right? And ABS, right? So here are some name of some instrument, as you can see here written here, right? So it is a part of the broader credit market, especially in non-trade and banking sector. Then we have securitization market. What it means? See, securitization, though tightly regulated, it opens the doors. So bank trade in securitized asset, including CDs on corporate bond, right? This help reshape risk and reward dynamic, especially in complex portfolio. So treasury is not just a department; it's a financial strategy hub, right? From forex deal to security, every transaction is a move in a well-played chess game, right? And understanding this give us a powerful insight into how banks truly operate behind the scene. Now let's look at the comprehensive overview of the treasury function. Friends, let's lift the curtain on the real engine room of the bank, the treasury department. It's not just about managing money, it's about strategic control, pricing, risk management. So here is a complete overview of its multifaceted function. First of all, it's the product offering. Let me zoom a little bit. I hope it is clearly visible to you. First of all, the thing is product offering. What does it mean? You can see whenever I say product offering, it means that treasury act like a product house, right? It act like a product house. So what is the meaning of product house? That they sell forex service, right? They sell forex service, and they sell derivatives, they sell structured product, right? Especially designed to meet the need of corporate client. So they sell all these to meet the need of the corporate client, right? That is called product offering. Then with this, it is where customization with financial expertise, product offering. Then we have corporate hedging need. You know what it means? Treasury provide hedging solution that protect corporate from market volatility. Yes, this hedging solution is provided by the treasury that protect corporate. It protect corporate from market volatility, right? If you need to lock in interest rate, then use FRA. FRA, forward rate agreement. We have already talked about it. If you want to lock the interest rate, use FRA. If you want to manage currency exposure, go for swap or go for options. It's all about converting uncertainty into clarity, right? That is called corporate hedging needs. Treasury provide hedging solution that protect corporate from market volatility. Two tools I told you: forward rate agreement and swap and options. Then we have profit central rule. What is the meaning of profit central rule? As you can see that, don't forget, treasury is also a profit center. Through transfer pricing, it assigns cost to the business unit based on factor like interest rate risk, maturity, and hedging cost. So through transfer pricing it does so. Through transfer pricing it assigns cost to factors like interest rate risk, right, maturity mismatch, and hedging cost. This ensures accurate internal cost allocation and profitability. If you look at the transfer pricing rule, remember, think of it like bank internal rent system. Treasury charges margin for being the bank funding arm. Yes, treasury charges what? Margin, right? And compensating itself for acting like a financial backbone. This adds discipline and clarity to the interdepartmental finance. And then we have advanced pricing model. See, behind every decision lie a model. So any decision that the bank take, there is a model that is lying. And treasury use advanced pricing technique, right? Often based on RAROC. You know what RAROC? Risk adjusted return on capital, right? Ensuring alignment with the Basel III capital norm. In simple terms, they are managing risk and reward the smart way. So friends, from crafting product to pricing the risk, from serving corporate to the driving internal efficiency, the treasury function is far more than just a support role. It's strategic powerhouse that hold the bank financial structure together. So you can see understand how much important is the treasury. Now friends, the last slide we have, this is super important slide where we are looking at front office, mid office, and back office. Very, very important from examination point of view. So friends, behind the scene of every successful bank treasury lie a well-organized machine divided into three core zones. There are three zones: front office, back office, and mid office. So let's decode the role and responsibility of each. First, let's talk about the front office. As you can see it here. So this is the face of the treasury operation. This is face of the treasury operation, right? Where the market action truly happen. It is led by the chief dealer, right? And this team is in charge of all the market facing activity. All the market facing activities lead by the chief dealer. And dealers are the only ones executing the trade in forex, money, or securities market. They cater to both corporate client and handle the ALM, right? So they cater to corporate client also, and they handle the ALM also, and they also manage the secondary market, right? They also manage the secondary market for securities like government security and treasury bill, right, and equities effective. So again, I'm repeating, chief dealer, right? So chief dealer, they leads the goal. This team in charge of the chief dealer, and they cater to both corporate client and handle ALM. Yes, corporate client and ALM both are handled, and they also manage the secondary market like government security, treasury bill. On the corporate side, if we talk about the corporate side, they also handle investment proposals backed by thorough research. Chief dealer, right, forex, money, security, this thing you must remember. Security market, basically they handle they caters. They are dealers are executing trades in forex market, derivatives, and securities, and they also manage the secondary market for securities like government security and treasury bill. If you look at the mid office, so the brain that monitor risk and compliance, right? So basically this is the watchtower, you can call them the watchtower, right, of the treasury, tracking risk, performance and compliance. So it manages MIS, management information system and risk system, ensuring KPI monitoring, right, KPI monitoring, key performance indicator monitoring, and setting the and set the trading limit. You can see they set the trading limit and they also monitor the KPI, key performance indicator, right? It even handle the transfer pricing, and and offer ALM support. Remember, questions are asked based on this. They offer ALM support also, right? It works closely with the risk head and maintain independence under ALCO to comply with the RBI norms. And finally, let's look at the back office function. On the right hand side you can see, so basically back office, the gatekeeper of the accuracy and settlement. They are the gatekeeper of the accuracy and settlement. This is the backbone. This is the back office. You can think of backbone of the security operation. This is where everything get verified, settled and recorded. So it handle the trade verification, it handle the trade settlement, right, and account reconciliation, right? And it manage the bookkeeping, RBI return, as well as ensure the timely payment. And most importantly, it help mitigate the legal and reputational risk. It avoid legal and reputational risk. So basically it also ensure that front and back office role remains segregated, avoiding conflict and ensuring a strong internal control. So a great treasury is not just about market brilliance. It's about a structure, segregation, seamless coordination. From market maker to risk manager to settlement expert, everyone plays a vital role in keeping the engine running. And that is all you need to remember for this entire topic, nothing extra. If this video added value to you, please hit that like button. Please share this video with your fellow CIB aspirant who are preparing for CIIB. This will definitely help them also. And if you want a structured way to prepare in just limited time, you can enroll in our crash course, which offer you 35% discount on the same. For more detail, feel free to WhatsApp me on this particular number. Thank you for watching this video. Stay tuned for more. Thank you.